Hello everyone, welcome to Just Invest Today, and today we're talking about Mohnish Pabrai and this new interview he did at Georgetown University. And guys, Mohnish Pabrai has been going on a tear. He's released like 3 to 4 interviews already, going through different universities and talking about what he's learned from this year, important lessons that he's gathering, and man, this interview is really good. Definitely check it out. I'm gonna link it in the bottom. But I want to go through 3 important lessons that I learned from this interview alone. And these are actually stuff, see, like stuff like this is always, you gotta write it down, get these kind of ideas stuffed in your head and make sure you remember them because they're very key if you want to go, if you want to be in this investing journey for a long time. All these Mohnishs Pabrai interviews are very good interviews and lessons that you can take from it. So the first thing that I've learned from this interview, so basically this guy asked him a question about kind of like past mistakes, kind of like good things or bad things, and he talks about you learn the best lessons from your losers. So he goes into his losers and he talks about he got a history, he made a checklist of what the best investors, what did they do wrong? The 3 main things the best investors did wrong with visible information that they could have seen and they still got the investment wrong because Mohnish Pabrai actually has multiple investments that went to zero. See guys, we do not want any of those investments that go to zero. We can't be out of the game. We can't be having those really bad down years where we're negative. Like he said, he lost like 50 to 60 million. That's a lot. That's a big hit, and we don't want that. So learning from the mistakes is so key. So on his checklist, the number one thing that you gotta watch out for is leverage. So leverage is what a lot of these big investors got killed on. So that's companies with like a lot of debt, long-term debt. And it's specifically, guys, you gotta check to see when is that debt expiring on that balance sheet and can they pay it off? Like, are they generating enough free cash flow to pay off that debt just in case? So sometimes you can't just look at the cash on the balance sheet. You gotta look at how are they generating money to be able to pay off that much debt that they have on the balance sheet or the short-term debt that's going to be due soon. Because I remember a story about Phil Town. He's saying that the cash on the balance sheet, sometimes they can still claim bankruptcy even though they have that amount of cash on the balance sheet. But if they're not making free cash flow, then they can still claim bankruptcy because they're not generating enough money to pay off that debt, even though they have cash in the company. So remember, you gotta watch out for that just in case. So leverage. Be very skeptical, look into it, see what's going on. Second thing that he mentions the moat. You gotta be certain that this company has a moat. And you can be certain that a company has a moat. First, you gotta come to your own thesis, but after that, you can look at the numbers. Most realize you can look at the numbers to see what kind of moat that company has, and it kind of like certifies you in saying that okay, I can see the moat, and then I can back that moat up with the numbers, that competitive advantage with numbers, and you can see it on the balance sheet. So make sure that your company has moats because the moat is going to stifle the competition. It's not going to allow people to come into the business and just kind of take it over because when people see that you're making money, when competitors see you're making money in the business, you're going to get a lot of people coming in. But if you have a competitive advantage to stop that, like you have low prices or you built up a huge network like Facebook, no one can break that. So make sure these companies have a moat and don't trick yourself in thinking that this company has a moat. Just double check, triple check, check by the numbers. So make sure your company has a moat. And the last thing he says, number 3, is management. Management is very key, guys. So when we're looking at management, we should honestly kind of look back and see their history. Like, are they true to their words? And that's how you can kind of see if management's reliable and see what kind of like job history they have too. Like, even check on like any kind of site to see what have they done in the past and are they true to their words? Like, are they saying the right things too? And are they backing those words up? So that's kind of how we can kind of check management to see if they're doing the right things and saying the right stuff. So management is key too, because remember, we gotta look for management that's actually reinvesting our capital at a high rate. Because Chris Meyer says that's the number one thing. Like that's how we know the company's doing a good job. They're reinvesting that capital and like they're growing the business. So we gotta make sure management is doing good with the capital they're gaining on that business. They're reinvesting it, and they're making progress with that company. And that's how we're gonna get these high growth companies that are gonna compound years and years ahead of time. So look out for management, what they say, and make sure they're not doing weird stuff and they're not backing up what they're saying. And if they're kind of being like sly with their words, or they're not talking about the problems that you see in the company, be very cautious about what's happening and see if you want to get out of the business. So that's number three. Second, very important thing I learned in this video. Basically, the question asks, how can I look for like compounders and look for business with competitive advantages? And basically, Mohnish Pabrai says it's very simple. You can usually see it through the numbers in the company, the revenues, and the strong cash flow. Is that growing 10 to 15% year after year after year? You can usually see that in the business. As investors, we understand what's a good business. We can usually see what a good business is by just looking at the numbers and just looking, like, going through life and seeing what companies are doing good. Like, everyone knows Amazon, Apple, Facebook, um, all those businesses. We know those are all good businesses, right? So we can understand that, we see that. But the problem comes down to, are we able to buy it at the right price, right? So that's what it all comes down to. We know the great businesses. We can sift through different types of businesses and actually pick out the right ones, but are they too expensive? Are we paying a premium? And that's not what we want when we're investing. We want to pay below intrinsic value. So we have like a margin of safety, and we're gonna get those huge returns when that stock comes back to its value and it keeps increasing year after year after year. So that's an issue. And the way we solve that problem is, guys, it has to be the number one lesson in investing is extreme patience, right? People keep forgetting how patient investors gotta be. Mohnish Pabrai, Charlie Munger always says that investing in one company a year is enough. Just one company a year. Like if you find one good company to invest in, that's a good year. So think about how patient Charlie Munger is. Like, I know we want to be so excited and get all these companies and invest in everything, but like guys, if we find one solid company in a year, that could be a good year for us. So we get these we find these good investments, these good businesses, but they're going to be at a premium. So that's when we have extreme patience and we got to wait for either the business to have a short term problem, right? So it's either we wait for the business to have a short term problem, which decreases that share price like crazy, but we still know that business is going to be strong overall into the future, where that price is going to rebound. So we can look for that, or we can look for like a market decline, like we just seen. Like we seen like a 10%, 12% tech decline, right? So we wait for those one of those two events to happen, and that's gonna give us the opportunity to kind of go into these companies and buy it at a good price, and then allow us to hold those companies for a very long time. So that's the second big thing I took from this article, and just kind of remind me that I gotta focus on being very, very patient, especially in a market like this. And lastly, the last good point that I learned from this video, Monish Pabrai talks about how people, like, the question was asked about, okay, so he sees that a lot of value stocks are doing better now, that like all the high tech stocks have a high PE, and the value stocks are kind of coming back, and if he should kind of like switch it off. And then Mohnich Pabrai says, don't worry about PEs, guys. Like, PEs are inadequate, like, way to kind of value stuff. And if you see that, like, the forward PE is 23, but the company's growing at like 30%, then that company is actually not expensive, guys. And that brings me back to a thing too that Peter Lynch says in his book is that you never want to buy a stock with a higher PE than the actual growth of the company. So let's say that the company is growing at 15% and it's selling at 20 and it's selling at a 20 PE. Like Peter Lynch wouldn't want that type of company. He wants a company that's selling at like a 10 PE, but it's growing at 15%. So I can see how Mohnish Pabrai says like don't look at PE like it's not inadequate, but like if you're looking at the PE guys, make sure the growth is higher than the PE. That's what we want, and that's how we find kind of these undervalued companies. But the main thing is that business that you bought growing? Does it have a huge future prospect? Like in 5 to 10 years, can you see this business getting bigger, right? And how is the cash flow generation? Like that's what you want to look for in these businesses, right? You want to buy it at a a fair price or undervalued price, and just make sure that that business is growing its revenues, growing its cash flows year after year after year. And that's what we really want in these finding these strong businesses. And then he gives the example of Walmart saying that even if you bought it at like 100 times earnings or something, it doesn't matter. It would still gain you a huge return. So so basically he's just saying just focus on how strong the business is and don't worry about the PE. Ignore the market news, ignore what people are saying about it, because that's going to lose your focus and you're going to get distracted, and then you're probably going to sell off good companies just because it has a high PE. But that doesn't matter. So he's basically talking about going into selling your companies, and he's saying if the business is getting better year after year after year, you don't have to sell your companies, guys. You can just hold on and be steady. Just make sure the company is still strong, it's still growing, so you don't have to sell it unless it gets to some kind of egregious price that it's like, I don't know, like 100 times sales or something crazy like that. And he gives an example of Snowflake. Like he says Snowflake is way egregiously overvalued, so he would sell it at that point. But if it's not at that point, keep the company. No, it doesn't matter if it's like 90% of your portfolio. Just keep that company. It's still growing. It's still growing. Still, just let it grow, guys. Don't just cut it off. Like there's no point of that because it's still a strong company growing year after year. So that's basically like the last thing that the one of the last things that I took from it, and I just got to remember to keep these things in my mind when you're like looking at the market, when you're actually investing. And then the last thing is especially how does he view the market? And he said he doesn't really care about the market, what the market's doing. And yeah, so just don't focus on the market, don't care about what the market's doing. Just buy good businesses, hold them strong. But one thing I'm gonna say is that I feel like people should actually go back into your portfolio and actually like every like 4 6 months look at what your stocks are doing and just making sure they're growing, right? You don't want to just sometimes just leave it because sometimes your businesses can go bad, right? Even if you think you have a strong business, they can go bad. So just check up on your businesses periodically and make sure they're still a strong business, they're still growing, the management is still in line, because you don't want to get into a business that you kind of like leave and forget, and then they end up doing really bad and they don't recover because you didn't like check on that business to make sure everything is good, it's going strong. So that's what I got from this interview, guys. This Georgetown University interview was amazing. Go check out the full interview, but this is just my little like clips about it that really stuck out to me. So guys, if you like this video, like it, subscribe to my channel, I'll get back to you in the next video. Peace.